On the morning of October 16, 2001, Enron was the seventh largest corporation in the United States. They traded hundreds of billions of dollars in energy, bandwidth, and weather futures. Their executives were treated like rock stars, and their balance sheet showed a company that was not just profitable, but invincible. Yet, in the Treasury Department, panic was setting in. Because despite reporting massive, consistent profits quarter after quarter, Enron had a secret problem that shouldn't mathematically exist for a profitable company. They had no cash. They were arguably the richest company in the world, on paper, and completely broke in reality. This isn't just a story about fraud or greed. We've heard about Ken Lay and the Jets. This is a forensic investigation into the specific mechanical weapon they used to bridge that gap. A weapon called mark-to-market accounting. It allowed them to book 20 years of profit on a Tuesday for a deal that might fail by Wednesday. And the terrifying part? The accounting rule that enabled the greatest fraud in history isn't illegal. It is still the standard used by Wall Street today. Welcome to the deep dive. Most documentaries tell you Enron was bad. We are going to explain how they did it. We are going to take apart the engine. We will explain how Jeff Skilling turned an accounting textbook into a work of fiction. How the Raptors, entities named after Jurassic Park dinosaurs, were used to eat the company's debt. And how a mechanism designed to create transparency was weaponized to create an illusion. If you want to understand why the global economy feels fragile today, you have to understand the specific architectural flaw Enron exploited. Because they didn't break the system. They just used the system exactly as it was designed, until it exploded. By the end of this, you won't just understand Enron. You'll look at every earnings report from every major tech company differently. Let's open the books. To understand the crime, you have to look at the weapon before it was loaded. Rewind to 1990, Houston, Texas. Enron is a boring, rusty pipeline company. They move natural gas from point A to point B. It is a steady, slow business. You charge a toll fee for the pipe. It is unsexy. It is safe. And for Jeffrey Skilling, a brilliant, aggressive consultant from McKinsey, it was hell. Skilling looked at the natural gas market and didn't see pipes. He saw a financial market. He realized that gas prices fluctuated wildly, just like stocks or bonds. He proposed a radical idea: the gas bank. Enron shouldn't just transport gas, they should trade it. They should act as the intermediary, offering long-term contracts to buyers and sellers, insulating them from price swings. It was a brilliant concept. It transformed a physical commodity into a financial derivative. But there was one massive hurdle. It wasn't the gas, it was the accounting. Under traditional rules, if you signed a 10-year deal to supply gas, you booked the revenue as the gas was delivered, year by year. Skilling hated this. He wanted the credit for his brilliance now. This brings us to the pivotal moment that doomed the company a decade before it fell. January 1992. Skilling goes to the Securities and Exchange Commission, the SEC, with a request. He argues that Enron isn't a pipeline company anymore. It's a trading house, like an investment bank. Therefore, he argued, Enron should be allowed to use mark-to-market accounting. Here is how that works in simple terms. If you possess a stock portfolio worth $1 million today, you report that value immediately. You don't wait 10 years to sell the stocks to say you're rich. Skilling argued that Enron's long-term gas contracts were just like stocks. They had value today. So, if Enron signed a 20-year contract worth an estimated $100 million in future profit, Skilling wanted to book all $100 million as profit on the day the contract was signed. Think about the implications. You haven't delivered a single cubic foot of gas. You haven't collected a single dollar of cash. But your income statement says you just made a fortune. Incredibly, against the warnings of many traditional accountants, the SEC said yes. They handed Skilling the keys to the kingdom. This approval changed the DNA of the human beings working at Enron. Incentives drive behavior, and the incentives just became toxic. Imagine you are a salesman. In a normal company, you get a bonus when the customer pays the bill. At Enron, under mark-to-market, you got your bonus the second the ink dried on the contract. If you signed a deal that the computer models said would make $50 million over 20 years, the company booked the profit today, and you bought a Porsche tomorrow. Did it matter if the customer went bankrupt in year 3? No. Did it matter if the price of gas crashed in year 5? No. You had already been paid. Skilling created a culture where the only thing that mattered was origination, creating the deal. Execution was for losers. The parking lot filled up with Ferraris, driven by 28-year-olds who had never actually managed a project in their lives, but knew how to structure a contract to maximize its theoretical future value. Skilling even joked about it. He called it hypothetical future value accounting. It was a license to print money, provided you could keep signing deals. But there was a catch that the SEC overlooked. When you mark a stock to market, you look at the New York Stock Exchange to see the price. It's objective. But there is no 20-year marketplace for complex, customized industrial gas contracts. So where did Enron get the price? They made it up. They used internal models. They'd guessed the price of gas in the year 2005, 2010, 2015. And, strangely enough, every time they needed to hit an earnings target, the model would tweak the assumptions just enough to find the money. They had built a perpetual motion machine for stock prices, but they had forgotten one fundamental law of physics. Accounting profit is an opinion. Cash is a fact. And very quickly, Enron started running out of facts. By the mid-90s, the Enron building in Houston was the center of the financial universe. The trading floor was a cavernous, screen-lit arena that looked more like NASA mission control than an energy company. They called it the Death Star. Here, traders weren't just buying and selling gas, they were securitizing everything. They believed that with enough data and the right algorithm, they could commoditize the entire world. They traded electricity. They traded coal. They traded paper pulp. At one point, they even looked into trading weather derivatives, betting on the temperature to hedge costs for utility companies. The stock price was vertical. Fortune magazine named them the most innovative company in America 6 years in a row. The analysts on Wall Street were mesmerized. They saw a company that was growing its earnings by 20% every single quarter, like clockwork. Smooth, beautiful, upward lines. But inside the Death Star, the logic was beginning to fracture. Let's look under the hood of that smooth growth. How exactly do you manipulate a mark-to-market model? It comes down to something called the discount rate. When you estimate cash flow 10 years from now, that money is worth less than money today. You have to discount it back to the present value. If you use a high discount rate, say 15%, that future money isn't worth much today. It reflects risk. But if you lower that rate to 5%, suddenly that future money is worth a fortune right now. Enron's models were black boxes. Because these deals were unique and illiquid, there was no market check. If a trader needed to show a $5 million profit to hit his quarterly target, he could just tweak the discount rate or adjust the forward price curve of electricity in 2008. It was mark to model. They were marking their own homework. And because the auditors, Arthur Andersen, were making millions in consulting fees from Enron, they rarely challenged the math. The revenue recognition principle, which says you record revenue when it is earned and realisable, was completely abandoned for fair value, which in this case meant imaginary value. The most egregious example of this hubris was the Blockbuster deal. In 2000, Enron partnered with Blockbuster Video to deliver movies on demand over broadband. It was the Netflix idea, a decade too early. The technology didn't work. The bandwidth wasn't there. The deal fell apart within months. But before it died, Enron's accountants went to work. They modelled a scenario where the deal succeeded for 20 years. They estimated every movie rental, every subscription, every dollar of profit they might make if the technology miraculously started working. And they booked it. Enron recognised over $110 million in profit from the Blockbuster deal immediately. They put it on their earnings report. The stock went up. Executives sold shares. But the cash? There was zero cash. In fact, the project was bleeding money. This was the trap. To the outside world, Enron was a profit machine. Inside, it was a cash incinerator. They were paying taxes on imaginary profits, paying bonuses on imaginary deals, and spending real cash to keep the lights on. This created a terrifying mathematical divergence. On the income statement, the paper report, profits were skyrocketing. On the cash flow statement, the actual bank account, money was draining out. You can only sustain that contradiction for so long. To keep the stock price up, Skilling had to show more growth. To show more growth, he had to sign bigger, riskier long-term deals to book the immediate paper profit. But those deals cost real cash to set up. It was a treadmill that was speeding up. They needed billions of dollars in financing to plug the hole between their fantasy accounting and their cold reality. But they couldn't borrow it from a bank, because if they took out a loan, it would show up as debt on the balance sheet. Wall Street hates debt. If their debt load went up, their credit rating would go down, their trading partners would flee, and the game would end. They needed money, but they couldn't admit they were borrowing it. Enter Andrew Fastow. Andrew Fastow was the CFO, and he was the dark wizard of this story. While Skilling was the visionary dreaming of a commoditized world, Fastow was the mechanic keeping the engine from exploding. He understood the problem perfectly. Enron had volatile assets and massive hidden debts. If the market saw the volatility, the stock would crash. Fastow's solution was to build a shadow Enron. He began creating hundreds of shell companies. These weren't normal subsidiaries. They were special purpose entities, or SPEs. They had names like Jedi, Chuco, and LJM. The concept was simple. Take the bad assets, the debt, and the money-losing trading positions, and sell them to these shell companies. Enron sells the garbage to the SPE, books a profit on the sale, and the debt disappears from Enron's books. It was financial laundering. But wait, who would be stupid enough to invest in a shell company that just buys Enron's garbage? Here lies the specific loophole that broke the system. Under US GAAP accounting rules at the time, a company didn't have to consolidate, meaning disclose, an SPE on its balance sheet if just 3% of the equity came from an independent outsider. Just 3%. If Fastow could find someone to put up $3 for every $97 Enron put in, Enron could treat this entity as totally independent. They could sell debt to it, sell bad assets to it, and hide losses in it. But no outsider wanted to take that risk. So Fastow did the unthinkable. He became the outsider. He created partnerships like LJM, where he was the general partner, raised a tiny bit of outside cash from banks who wanted Enron's favour, and then used LJM to satisfy the 3% rule. Enron was effectively doing deals with itself. Fastow was sitting on both sides of the table. As Enron's CFO, he sold the assets. As LJM manager, he bought them. And because he controlled the transaction, he made sure LJM made a fortune, paying himself tens of millions in management fees. It was a conflict of interest so glaring it required a special waiver from the board of directors. And they gave it to him. Why did the board approve this? Why did the banks fund it? Because it worked. The SPEs acted like a rug under which all the mess was swept. When an investment in broadband went bad, Enron didn't write it down. They sold it to an SPE at the original price. No loss reported. Earnings remained smooth. The banks, Citigroup, JP Morgan, knew exactly what was happening. They often funded these SPEs with disguised loans called prepays. They lent Enron money, but structured it as a commodity trade so it wouldn't look like debt. In exchange, they got millions in investment banking fees. Everyone was getting rich. Fastow was hailed as a genius financial engineer. He was given an award by CFO magazine. The circularity was blinding. Enron was propping up the SPEs with Enron stock guarantees, and the SPEs were propping up Enron's earnings. It was a house of cards built on the assumption that Enron's stock price would go up forever. As long as the stock kept rising, the guarantees were valid, and the debt stayed hidden. But trees don't grow to the sky. In early 2000, the dot-com bubble reached its peak and began to burst. The technology and broadband sectors imploded. Enron was heavily invested in these sectors. Their mark-to-market gains on these tech investments began to turn into massive realized losses. Normally, a company would report these losses and their stock would take a hit. But Enron couldn't afford a hit. A lower stock price would trigger the guarantees they had given to the SPEs. If Enron's stock fell below a certain level, the SPEs would default, and all that hidden debt would come rushing back onto the main balance sheet. They were trapped. They needed a bigger hedge, a bigger place to hide the losses. They needed a monster. And so, in the spring of 2000, Fastow created the Raptors. The Raptors, named Raptor 1, 2, 3, and 4, were the final stage of the cancer. These weren't just standard off-balance sheet vehicles, they were logic-defying machines. The purpose of the Raptors was to hedge Enron's investment portfolio. Let's say Enron held $100 million in a tech stock. If that stock dropped to $50 million, Enron would lose $50 million. To prevent this, Enron bought a hedge from a Raptor. The Raptor agreed to pay Enron if the tech stock fell. Perfect, right? Except for one problem. The Raptors had no money. Their only real asset was Enron stock. Enron had capitalized the Raptors with its own shares. So, think about this. Enron was hedging against financial loss using a company whose ability to pay depended entirely on Enron's own stock price. It's like buying car insurance from yourself. If you crash your car, you still have to pay for it. If Enron's investments tanked, the Raptors owed Enron money. But if Enron's investments tanked, Enron's stock would likely fall, bankrupting the Raptor. It was circular. It was fraudulent. It was a time bomb. Throughout 2000 and 2001, as the market soured, the Raptors began to die. The investments they were hedging plummeted in value. The Raptors owed Enron hundreds of millions of dollars. But Enron's own stock was wavering. The Raptors were technically insolvent. They had a credit shortfall of over $500 million. By law and accounting rules, Enron should have declared the Raptors bust and recognized the massive losses on their own books. But Skilling and Fastow refused. Instead, they doubled down. They devised a complex cross-collateralization scheme, merging the healthy Raptors with the sick ones, hoping to buy time. They were effectively printing new Enron shares to prop up the entities that were hiding their losses. It was dilution to cover up insolvency. The accounting department was working nights and weekends, moving numbers between columns, frantically trying to keep the credit capacity of these shell companies positive. Internal memos from this time show confusion and fear. Even the accountants were losing track of the web they had spun. The pressure was becoming unbearable. Jeff Skilling, the architect, the visionary, the man who said he felt bad for people who didn't work at Enron, suddenly quit. On August 14, 2001, just 6 months after becoming CEO, Skilling resigned, citing personal reasons. It was the ultimate red flag. You don't walk away from the most innovative company in America if everything is fine. Kenneth Lay, the grandfatherly founder, returned as CEO. He told employees that the company was in the best shape it had ever been. He told them to buy the stock. But internally, the whistleblowers were starting to speak up. Sharon Watkins, a vice president, wrote an anonymous memo to Lay. Her words were prophetic. "I am incredibly nervous that we will implode in a wave of accounting scandals." She detailed the Raptor structures. She pointed out the emperor had no clothes. Lay saw the memo. He didn't fire the auditors. He didn't restate earnings. He called the lawyers to see if he could fire Watkins. The timeline accelerates. The market smelled blood. Short sellers began circling the stock, questioning the opaque financial statements. They asked simple questions. How do you make money? Where is the cash flow statement? Enron couldn't answer. On October 16, 2001, Enron released its third quarter earnings. They announced a massive $618 million loss. But buried in the press release, in language so technical it was almost indecipherable, was a mention of a $1.2 billion reduction in shareholder equity. It was a correction related to the unwinding of the Raptors. They had finally admitted the circularity. Wall Street paused. $1 billion of equity just evaporated? Why? The credit rating agencies, Moody's and S&P, warned that if Enron's debt rating fell to junk status, it would trigger billions in loan repayments immediately. The death spiral had begun. But Enron had one last card to play. They tried to sell themselves to their smaller rival, Dynegy. It was a desperation heave to save the ship. November 2001. Enron wasn't just a company anymore. It was a crime scene in motion. The Dynegy deal fell apart as due diligence revealed the black hole in Enron's books. The stock, which had traded at $90 a year earlier, crashed to under $1. On the trading floor, screens went dark. But the real panic was in the unspoken run on the bank. Enron's trading partners stopped doing business. They demanded their collateral back. It was a liquidity crisis of epic proportions. While executives were frantically trying to secure emergency credit lines, Arthur Andersen auditors in Houston began shredding documents. Tons of paper, emails deleted. They knew the subpoenas were coming. The mark-to-market valuations, the Raptor structures, the LJM approvals, the paper trail of the fraud was being fed into industrial shredders. It was the physical manifestation of the digital lies they had told for a decade. As the company collapsed, the final secret came out: the prepays. Investigators found that Enron had hidden nearly $8 billion in debt using complex trades with banks like Citigroup and JP Morgan. Here is how a prepay worked. Enron would agree to sell a commodity to a bank entity in the future, and the bank would pay them up front. It looks like a sale. But simultaneously, Enron would sign a swap agreement to buy that commodity back at a fixed price plus interest. Economically, it was a loan. The bank gave Enron cash, and Enron paid it back later with interest. But because it was structured as two separate commodity trades, Enron booked the incoming cash as operating cash flow, money from operations, rather than financing cash flow. This was crucial. It made Enron look like it was generating cash from its business, when in reality it was just taking out high-interest loans on credit cards to pay the mortgage. Without these prepays, Enron's cash flow would have been negative for years. The banks knew it. They facilitated it. They earned fees on it. The mechanism was systemic. While the bankers secured their fees and the executives cashed out millions, Ken Lay sold $300 million in stock while urging employees to buy. The rank and file were slaughtered. Enron's 401k plan was heavily invested in Enron stock. As the stock plummeted, the company instituted a lockdown on the retirement plan, claiming they were changing administrators. For weeks, as the stock fell from the mid-teens to pennies, employees were legally barred from selling. They watched their life savings evaporate on their screens, helpless to stop it. Janitors, administrative assistants, pipeline operators, people who didn't know what an SPE was, lost everything. 20,000 people lost their jobs. $74 billion in shareholder wealth was destroyed. It was the brutal reality of the agency problem. The management, the agents, had acted entirely in their own self-interest, destroying the owners, the shareholders, and the employees. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. At the time, it was the largest bankruptcy in US history. The giant was dead. But the autopsy was just beginning. In the years that followed, the legal system would hunt them down. Fastow went to prison. Skilling was sentenced to 24 years. Lay was convicted but died of a heart attack before sentencing. Arthur Andersen, one of the Big Five accounting firms, was indicted for obstruction of justice and effectively ceased to exist, putting 85,000 people out of work. Congress passed the Sarbanes-Oxley Act to fix the rules. They closed the loopholes. They banned the consulting conflicts. They fixed the system. Right? Wrong. They fixed Enron's specific tricks, but they didn't fix the philosophy. Here is the uncomfortable truth. The core mechanism, mark-to-market accounting, is still the standard. In fact, it's used more today than ever before. Banks, hedge funds, and private equity firms all use fair value accounting to value their assets. And just like Enron, when there is no active market for an asset, they are allowed to use level 3 inputs. That is the technical term for mark to model. They estimate the value based on their own assumptions. Sound familiar? Look at the commercial real estate market today. Look at the valuations of private tech unicorns. Are those values real? Or are they hypothetical future values based on discount rates that haven't been updated to reflect the new interest rate reality? Enron wasn't an anomaly. It was a preview. The lesson of Enron isn't that fraud is bad. The lesson is that accounting is subjective. Profit is not a hard number, it is an estimate. Enron proved that if you give smart people an incentive to manipulate that estimate, they will find a way, and they will convince themselves they are doing nothing wrong. Skilling didn't think he was robbing the company. He thought he was managing earnings to buy time for his brilliant strategy to work. He confused the map, the financial statements, with the territory, the cash. Today, we have better disclosures. We have Sarbanes-Oxley. But the incentive to pull future earnings into the present remains. The pressure to show smooth growth remains. And as long as those incentives exist, there will be another Enron. It won't look exactly the same. It won't use gas pipelines. But it will use the same logic. The future is certain, so let's spend the money today. Enron collapsed because it ran out of cash. That is the ultimate truth serum. You can fake profits, you can hide debt, you can shred documents, but eventually you have to pay the light bill. When you look at the market today, ask yourself, who is booking profit on 20-year promises? Who has complex off-balance sheet vehicles? Who is telling you that this time is different? The next collapse won't come from a pipeline company in Houston. It will likely come from a sector you think is invincible, using accounting you think is standard, audited by firms you think are watchful. The mechanism is still there, waiting for the next Jeff Skilling to pick it up. If you want to spot the next Enron, don't look at the profits, look at the cash. And make sure you are subscribed, because we are going to tear apart the next bubble before it bursts. Class dismissed.